Thank you, David, and welcome. Good morning, everyone. My name is Vincent. I'm Head of Global Market Intelligence and Forecasting at MAGNA. And on behalf of the whole analyst team, I want to say thank you for joining us this morning. We really appreciate you coming here downtown, and we appreciate your feedback on our research all year long. Before I start with my presentation, I just want to give you a couple of reminders of what we do and how to find it. These are our key syndicated publications. Not all of them, but some of them. And you're probably already familiar with our classic reports, the US ad forecasts, the category report, the programmatic reports, the media economy report right in the middle here. But in fact, we publish a lot of other reports throughout the year on a variety of topics touching the media trends. I just want to mention a couple here. The sports reports, the multicultural audience reports, the international market profiles, and finally, recently we updated our global media inflation report. So browse our website and you might discover a report that you don't already know and that might be useful to you. And talking of which, how to find them, how to get that research. If your company is an active subscriber to MAGNA Intelligence, you have unlimited access. But each individual user needs to get an individual login. So the URL to get that login is here. If you don't already have one, I encourage you to get one. So that was my practical reminders, and let's get started with the presentation itself. So the theme of my ad market update this morning is the growth paradox. So the economy, the US economy is booming at the moment, at least nominally. Every macroeconomic indicator is in the green, and the advertising market is growing. But it is not growing as much as you'd expect for guys like us, data geeks, statisticians, looking at the long term. In that type of an economic environment, you'd expect more growth. So that's the first paradox. The second one is that, yes, it's growing, but not everyone is benefiting. And a number of advertising verticals, a number of industries are actually not expanding their marketing and advertising spending. And that is having consequences on a number of media categories. And again, growth is not equally shared across the board, and we'll have a look at that too. So three things for me this morning. First, an update on our latest ad spend forecasts published in March. This interesting milestone, digital media ad sales reaching 50% market share this year, and what it means for everyone else. Second, the growth gap that I mentioned earlier. The economy is booming, but advertising spending is under pressure and advertising revenues are scarce for some media categories. And finally, the vertical divide. By that we mean the fact that ad spend patterns and media mixes in consumer good industries are increasingly diverging for what we see in other sectors. So we'll have a look at that. It's a relatively recent trend we unearthed, and we'll look at the consequences for national TV in particular. All right, so let's get started with the first theme. Digital media reaches 50% market share. This is from our March report, our latest ad forecast update. You're looking at net advertising revenues on a quarterly basis, year-over-year growth. You can see that the 2017 finished on a high. The fourth quarter, based on our analysis of quarterly earnings, the fourth quarter was the best of the year, plus 5.5%, after a sluggish start of the year. but the beginning was possibly struggling because it was comparing with a booming 2016. So good second half in 2017, but we remain cautious on 2018. As you can see, we only expect 3.5 to 4% growth for the first half of 2018. So 2017 finished on a full year basis at plus 4.5% growth. That is excluding cyclical ad revenues. But this 4.5%, that's the first imbalance of many we will mention this morning, is in fact the weighted average of digital ad sales growing by an impressive 18% last year, and non-digital ad sales, everything else, shrinking by 4.7%. And for 18 and 19, we expect more of the same. We expect traditional ad sales, non-digital ad sales to decrease by 5% or so, while digital ad sales will still grow double digit, but will slow down somewhat. We expect 40% in 2018 and 12% the following year. Looking at 2018 forecasts in more details, from left to right, national TV excluding cyclical events, we expect -2 in net advertising revenues. If you put the incremental revenues derived from the Winter Olympics and the FIFA World Cup, that would be about flat for national TV. Local TV revenues will grow by about 10% this year, but if you strip out political incremental revenues, it would be a -4. Digital plus 14, I already mentioned that. I'll come back to digital in a minute. Print, averaging newspapers and magazines, we are looking at -18. And I should say that's paper only. We'll come back to that. Linear radio, -4%. And out of home looks like it's going to be the only traditional media category to manage some moderate growth on a non-cyclical basis this year.
Just one thing I would say, if anyone has any questions on anything that Vincent is saying as we're going through it, don't hesitate to raise your hand and ask. Okay? Yes, someone has a question. How time?
I was just curious, the increase in out-of-home, is that because of digital out-of-home?
Yes.
Okay.
Yes. That's, and it's because there's still a lot of investment, and just in New York, as you know, Outfront and the MTA will roll out thousands of digital panels in the subway in years to come. So it's going to be a major driver.
And where does addressable TV fit in?
Addressable TV would be mostly today we don't itemize it yet, but it would be probably inside TV right now. Yeah.
We're going to deal with that later in that presentation in detail.
So overall, 2018, non-cyclical advertising revenues will grow by 3.7%. Keeping the incremental cyclical events, that's a 5.5%, which is decent, but not super strong for an even-numbered year. So if digital advertising sales grow by 14%, as we expect them to do, that will bring digital media market share to 50%. So that's a nice, round, symbolic milestone, following the previous milestone, which was just 2 years ago, when digital surpassed linear TV ad sales in 2016. From this point, what's going to happen? Well, our current long-term forecast has digital growing to 65% market share by 2022. So that's almost 2/3 of all advertising spending. And to give you some perspective, we monitor 70 countries, and at least 3, the UK, Sweden, and China, will pass the 60% mark this year already. So 65% sounds like not a crazy forecast, but a logical path given the rapid change in media behavior. Moving on to a zoom on digital media and what's driving digital media spend these days. So again in 17 it was, and again in 18 it's going to be mobile, video and social capturing most if not all of the digital growth. Looking at the right side for a start, we see that we expect digital-based clicks and impressions to grow by 30%, while desktop-based ad revenues will actually shrink. On a format basis, looking at the left side, the fastest growth will again come from social media, although it's expected to slow down from almost 40% last year to 30% this year. Video will grow by 23%, and search ad sales will grow double digit again. We expect 13% this year, and that will be enough to keep search the number one digital format comfortably with about $46 billion this year. Meanwhile, display formats, as in static banners, are shrinking now due to ad blocking and basically the problem for that format to adjust in a mobile-centric, app-centric world. So here you see the traditional way of slicing the advertising market, the way we've been analyzing it for years. When you look at that, you could argue that it's increasingly inaccurate because in the big blue digital box, you have a lot of television content and audio content and publishing content. So in a way it's unfair because what we call TV or what we call radio is only capturing the legacy traditional way of delivering ads. So we agree at MAGNA, and that's why in the last 2 years we've been publishing an alternative way of looking at the market that we call the holistic view. It's a platform agnostic, technology neutral, format-centric breakdown of the advertising marketplace. So for instance, what we call video here is putting together linear television advertising revenues, $61 billion this year, and the different digital video formats, $12 billion this year. So you've got a $73 billion block, which is kind of growing, at least stable, whereas linear TV alone is decreasing by 3% per year. However, if you do the same thing with audio and publishing content, well, adding the digital sales to the traditional sales doesn't quite stabilize the revenues. We end up with a -3 for audio and a -13 for publishing. So editorial media is not showing much growth. The main winner, of course, is what we call direct here, putting together the digital native ad formats, such as social, plus the traditional direct formats, such as direct mail. That is shrinking, but overall, direct is growing by 13% in 2018. That was the update on advertising growth. Now let's move on to my second theme of the morning, the growth gap. The paradox of a booming economy, but a low growth advertising economy. So let's remind ourselves of the economic environment. This year, real GDP is expected to hit 2.8%. That is strong. On top, we have nominal personal consumption, which is less volatile and which we consider a better predictor of advertising spending because it's a precursor to retail sales. It's going to be strong too this year. Industrial production is the most volatile of those macroeconomic indicators, and it was actually mediocre for a couple of years. It's now coming back strongly too. So all Economic indicators are good, but you can see that macroeconomists are predicting a slowdown in 19, 20, and 21. Now, in yellow on top, advertising revenue growth. And the idea is that over the long term, and we have 40 years of data, we do find a decent correlation between the macroeconomic environment and the level of advertising spending growth. But in the short term, it's not that good because other factors are kicking in. 2016 is an excellent example with an economy that was mediocre, but an extremely strong year for the advertising market. And we've got the opposite situation right now with a very strong macroeconomic environment, but we see advertising growth slowing down. So to recap the economic environment, real GDP plus 2.8%, gradually slowing down. Personal consumption 4.7%, also predicted to slow down next year. The consumer sentiment, consumer confidence at a 20-year high. And this one is interesting because people are confident. People have seen wage increases. The rate of savings is at 2% right now, which is a 12-year low. It was 11% after the Great Recession. To give you an idea, it was 5% just 2 years ago. Now it stands at 2%. That's extremely low, which means people are spending their increased revenues, their increased income. So that should be good news for all consumer industries, and that should trickle down to advertising spending. But it doesn't really, or it doesn't as much as we'd hope. And this is one of the reasons. Consumers are spending instead of saving, but they're not spending in ad-intensive verticals. And what we call ad-intensive verticals would be the sectors where brands spend a high proportion of their revenues into marketing and advertising. An extreme example on the left, movies. Hollywood studios spend the equivalent of 23% of box office just to support film releases with advertising campaigns. So that's an extreme example, but you have food and drinks, personal care, pharma, insurance to a degree, that are relatively strong, all spend 3 to 5 to 6% in some cases of their revenues, reinvest that much of their revenue in advertising campaigns every year. But the problem is that's not where people are spending their increased revenues these days. They rather spend it on the blue categories, finance, retail, technology, telco, and those have always spent a lot less, 1.5% maximum of their revenues into marketing. So that's one explanation for the growth gap. Another one is the imbalances of growth. That is the median household income over the last 40 years. 50 years almost, yes, 50 years. And you can see that just 2 years ago, we caught up with the level of median income that we had in 1999. And by the way, it's inflation adjusted. This current cycle of growth took a long time before it led half the population to the level of wealth that they had 20 years ago. But that's good news, I guess. Problem is, it's really not shared. Around the average, you have, there's many ways of slicing the population, but for instance, if we take ethnic groups, Asian Americans have more than caught up with the median income of 20 years ago. Now they stand at $81,000 on average. White non-Hispanic households have also caught up, stand at 65 right now. But then you have Hispanic households, haven't caught up, still lagging on 1999. And African American households, it's even worse. So here you go. That's also one of the reasons why consumer goods and services industries are not doing so well and feel the need to save on expenditure, and marketing is one of them. My third theme in this ad market update is the vertical divide. That's a relatively new thing we've started to observe in the last 3 or 4 months, really, when the data became clear. So let's have a look. So just to remind ourselves, around 23% is the average share of national TV across the key spending verticals: auto, movies, finance, food, personal care, 23%. Here we see how net advertising spending, and I insist on net because we adjust Kantar data to find those numbers, net ad spend has traditionally been very high in some categories such as, I've already mentioned, movies, pharma, personal care, food and drinks. I'm sure you're not surprised by that, but it's massive. It's like double the average share. And the thing is, over the last 2 years, 17 compared to 2015, not only have we seen that share maintained, but increased in some cases. So movies went from 61 to 66, pharma from 55 to 57. So it was not anticipated. We were anticipating that from such a high level of reliance on national TV, those sectors would start to diversify. At the other end, you have the low TV sectors like retail or technology. They went the opposite way. They reduced their TV share in the last 2 years. Although you could have expected them to increase because they were so low, and big technology companies are now launching consumer products, so they need a certain dose of TV, but it didn't happen. So basically what we are seeing is if we create a map with the share of national TV horizontally and vertically the growth of total advertising budgets, and remember, 23% is the average in terms of national TV. If we put here all the key verticals, and by the way, the size of the bubbles here is proportional to actual net spend, we see 2 groups. A group that we call the TV-centric here, with, again, movies, pharma, food and drinks, personal care, restaurants, high share of national TV, but you can see that vertically they tend to be near the line or below the line, meaning they've not increased marketing spending in the last 2 years, which means on those sectors, TV get a stable or growing share of shrinking budgets. On the other hand, we have the digital-centric sectors, technology, finance, insurance, and retail, that are under-indexing on TV. That's where the growth is. That's where marketing and advertising budgets have been expanding in the last 2 years. And the thing we've observed, that is not really new. What we've observed and what surprised us is the fact that those 2 groups seem to be drifting away from each other, although we were expecting them to converge. We are looking right now as a divergence. Another way of expressing that idea, TV-centric sectors here in green, digital-centric sectors. The share of national TV went down for both of them, but it continues to go down for the digital-centric, but the TV-centric have stabilized or are going up a little bit. That's what we saw in 2017. Now, it remains it's undecided if it's going to be a permanent feature or if it's a temporary pause in the long-term diversification. My personal bet is that it is a pause. I don't know how long that pause will be, but ultimately the scarcity of national TV inventory, the rising CPM costs will prompt a lot of brands, including in those TV-centric sectors, to resume the diversification at some point, possibly when their concerns over digital media formats will be somewhat alleviated. But in the meantime, the loyalty of those consumer goods sectors is what maintain a high level of demand for national linear TV, and combined with the ratings crisis that Brian is going to tell you about in a minute, that's what's fueling strong inflation. And we've seen 9-10% net CPM inflation for the last 3 or 4 years, and it's going to remain that way in the short term as we see it. On the right side, you can see the scatter premiums. We don't need to look at the numbers specifically, but suffice to say it's been above 10% for the last 3 years now. So it's another way of looking at television cost inflation. But despite this strong pricing environment, national TV net advertising revenues are shrinking. It's not collapsing, but eroding year after year. So this year we expect English broadcast networks, ex-cyclical revenues, to decrease by 3%, Spanish broadcast networks by 3.5%, cable networks by an average 1.3%. It could be a lot more for some of them, and syndication will be down too. Again, this is ex-cyclical. The sports events of 2018 will somewhat help the broadcast networks. Again, what we saw was the revenues from traditional linear ad sales. You could argue it's unfair because television broadcasters are getting some digital ad sales. So this is the view. This is again the holistic view. Just looking at the right side, national TV, linear advertising sales minus 2% in yellow. In black, that would be the digital television sales. That includes Hulu and the revenues from the full episode players. That is growing to that's going to grow to our estimate by about 11% this year. And again, if you put the two things together, well, the digital growth is not quite strong enough from a low base to fully stabilize national television revenues. Close to stabilize, but not quite. Minus 1.5% is our prediction for 2018. And finally, to finish on a tweet, on a soundbite, as digital media now captures 50% of total ad dollars, consumer goods remain largely TV-centric for now.